So, the biggest fear most people have with investing is losing money, but there's actually a strategy you can use to avoid losing money in the stock market. And no, it's not avoiding investing completely. It actually comes down to two simple rules. Let's dive in. So the two rules go as follows. Rule one, don't lose money. Rule two, don't forget rule one. Now, I have to give credit to Phil Town. He actually has a book titled Rule One. I'm a big fan of his teachings. You can also check out his podcast and his YouTube channel. But then Warren Buffett is actually the guy who said this originally. And there's a lot of wisdom behind this. And I'll actually give you a few case studies on how I've applied this to make sure I actually don't lose money in the stock market. So let me share with you two case studies, starting with number one, which is Rollins. Ticker symbol is ROL. This is probably about 2016 or 17. I was using Tykr in its Excel format before it turned into a software. And the stock was on sale. And I went to buy the stock. And I was looking at the financials. They're looking good. I like the business model. Just for context, Rollins, they own Orkin and a lot of other products out there that help get rid of like termites and ants and kind of pests that can intrude in our homes. And it's a company that's not going away anytime soon. They've been around forever. So that M checked out. Then you look at the competition. Rollins has a habit of buying competitors. Rollins is here. Competitors keep selling more. And then what happens is Rollins is like, hey, we're just going to buy you out. So they just take that business, buy it. And next thing you know, they have another revenue stream, which is a really smart play. And then they have really good leadership. So the 4Ms in my book checked out. But an earnings report came out. Financials were declining. And the stock changed from on sale to overpriced. And next thing you know, the share price went below my cost basis being the average buy price. So then I had three options at that point. Option one, I could freak out and sell for a loss. And I know a lot of new investors, they arrive, they're like, oh my gosh, what should I do? So that's option one. Option two is I could hold, or option three, I could buy more. Now, in most cases, when I have a business that's on sale and it drops, that's called a stockpiling event. That's the number one most important thing to do with investing is you want stocks, you want the market to fall because that's when you buy more. And when it corrects, that's when you make the big return. So I wasn't going to freak out with option one, and I wasn't going to stockpile in this case with option three, which brought me to option two, which is the hold strategy. And there's an old saying out there, and you'll probably hear this if you listen to Motley Fool, which is a rising tide lifts all ships. And what that means is the market goes up and down like an ocean. Well, there are circumstances when the market can rise and it's going to lift everything up with it, the good businesses and the bad. And that happens a lot. So what you want to do is, with rule one, don't lose money. Rule two, don't forget rule one, is you hold and you wait. And I think with Rollins, I waited like maybe 6 months for that share price to rise above. The financials weren't changing, but the market was looking really good. It was pulling everything up. Of course, really good businesses that are on sale and Tykr rise up a lot faster, but it was pulling Rollins up and went higher than my cost basis. And that's the moment when I said, I'm selling for a profit and then taking my gains and putting it into another business. Rinse and repeat. So here's case study number two with Callaway. Callaway is also known as Topgolf Callaway today. The ticker symbol is MODG. As we speak, the stock is actually on sale and Tykr looking really good. But anyway, Topgolf at the same time, I think it was 2016 or 17, again, on sale business, looking really good in this Excel sheet, the first version of Tykr. The meaning of the business, I'm a golfer. Again, I always say this, I'm not going pro anytime soon, but I really love the game. And Callaway's a big brand. They sell a lot of different products, from golf clubs to bags to balls to any kind of product you can think of within golf, the sport itself. So Callaway's not going away anytime soon. You look at the competition. There's a few other great brands out there, but Callaway, in my book, is that's a top choice for a lot of people. And then you have the management, and they're a really well-run company. And even since, they've really evolved. They've got the Topgolf component, but this was prior to Topgolf. But anyway, solid business, but just a circumstance. You had a bad earnings report and the financials started to decline. What do I do? Okay, so the share price dropped. I've got my 3 options again. I can freak out and sell for a loss. Option 2 is I can hold, or option 3, I can stockpile. So I didn't do option 1 and freak out, and I didn't do option 3 because my conviction wasn't as strong. I'm really big into tech businesses. I love the scalability of SaaS. And this is not a SaaS business. Yes, it can still grow, but it's not going to grow as fast. So I'm like, you know what? Option 2 it is. So I waited. And instead of 6 months, I think I waited about 9 months for that share price to rise above that cost basis. And that's when I took my gains and applied them to another business. A part of me is like, maybe I should have held this because it's on sale today. But anyway, in those 2 case studies gives you an idea that don't freak out. Remind yourself that a rising tide lifts all ships. And if you don't want to lose money, just simply wait, because you have to remind yourself that we're not investing in stocks, we're investing in businesses, and businesses are continuously selling products and services that generate revenue. They're not going to wake up one day and be like, you know what? We're going to stop selling to our customers. That conversation is never going to happen, especially for these 2 pretty simple business models. So just remind yourself of that. If you buy a stock, it goes down. Don't freak out and sell for a loss. Just wait it out and you can make a profit. Now, some of you might be asking the question, what about opportunity costs, which is essentially, should you wait to take the profits later on, or should you sell right now, take your losses and go apply some of the funds into another stock, maybe a stock that's on sale, and ride that stock up quickly? So you can do that. I would say the discipline is a little riskier, and I say discipline because of this. Warren Buffett, in most cases, and there's a lot of strong investors out there who have done the same thing, it's the discipline of not losing money and just repeating over and over the same process. Because you can get into the habit of a stock goes down, selling for a loss, putting it into another business and watching that take off like a rocket. And sure, that'll happen in some cases, but in some cases it won't. I found it to be a lot more peace of mind to just go into the market knowing you're not going to lose money and sticking to this strategy, which is essentially, if the share price does go below your cost basis, you wait and you keep waiting till it rises up. That way, you know, no matter what, you're not losing money, especially if you're buying strong businesses. And I can tell you this, if a business has achieved an on sale rating, and let's say it drops to watch or overpriced in Tykr, it can get back to on sale. There are other cases when it could be a penny stock that has horrible financials, overpriced in Tykr. Has it ever reached on sale before? No. In that case, it's a lot harder to get on sale. So just to reiterate that, if it's been on sale before, it can get back there again. And especially if it's a business that's continuing to sell, it's reputable, it's well known, it can rise with the tide and you can make a profit. So overall, hopefully this gives you a little peace of mind on investing in the stock market and how to not lose money. If you like this video, hit that like button. If you want to see more like it, hit that subscribe. If you want to learn more about investing, check out Tykr.com. All right, see you in the next video. Bye for now.